Welcome everybody. Today is November 5th, and I'm Kelly Keenan, Cameron Mealy. We're here for the monthly Ellsworth Advisors update. Today we're going to talk a little bit about what's happened over the last month from an economy standpoint, what's happened with the markets, and also what's been going on with our portfolios. We'll also give you some insight as to what we're thinking moving forward, throughout November and through the rest of the year. I'd like to start this off. Cameron, how about a little bit of economic update?
Thank you, Kelly. Good morning, everybody. Really interesting, Kelly. We continue to be in this Goldilocks economy where things are not too hot, they're not too cold, just kind of staying down the middle of the road. Interesting, most of our viewers probably know, but the Fed cut interest rates 25 basis points last week. That was the third cut this year, and at the beginning of the year, we were expecting 4 rate increases. So it tells you that the Fed does have some concerns about the economy. If we are going to go into a downturn, they're trying to make sure that it is a very soft landing. They're basically doing their job. As they see the economy change, they're reacting. So 3 interest rate cuts, which means, again, we're in a historically low interest rate environment. We've also seen over the last month a little bit of a rebound in the consumer. Consumer spending has it ticked down, and now it's ticked back up. That's being driven a lot by low unemployment. Yet again, we're at 3.6%, which is historically low unemployment, not only nationally, but across all ethnic classes in the U.S. We're seeing historically low unemployment. Also have seen an uptick in average hourly earnings over the last several quarters. So people have more money in their pockets. The consumers out there spending. They're driving the economy because we are seeing some softness in manufacturing. So healthy consumer, softness in manufacturing. Corporate results have been favorable.
Better than expected.
But the bar was set pretty low.
Exactly.
But, anytime you have a strong consumer, you have companies doing well. Manufacturing, we say softness, but really a lot of that is probably a China trade issue and people just pulling back their investments in capital equipment.
Well, energy kind of tends to fall in that sector, so energy has definitely been challenged this year with low oil prices. We saw, kind of a manufacturing recession in 2011. And then part of 15, 16, it was basically the consumer that drove us through those periods. Is really what's going on there.
Yeah. And interesting, as we talk about the U.S. economy still being the Goldilocks economy, not too hot, not too cold, it continues to be the best economy in the world.
Correct.
And, we've got better interest rates in the U.S., we've got better growth rates right now, we've got the strong consumer, and the capital keeps coming towards the U.S. Did want to mention one interesting subject that I found. This is from the U.S. Conference Board. This is GDP growth rates. This is a forecast for the period 2020 to 2024. U.S. Conference Board puts the U.S. GDP growth rate at 2% per year on an annual basis.
From when? 20 to 24?
20 to 24.
Okay.
If you let's look at the rest of the world. Europe, 1.5%. Some countries. The United Kingdom, 1.2%. Japan, 1.8%. All mature economies together, 1.9%. So we look at the mature economies. Obviously, the U.S., the Conference Board expects to maintain as the strongest of the overall economies over that 4-year period. But even if you look at some of the developing world, China, 3.4%. India, 5.9%. 5.9%, incredibly strong. Latin America, 1.7%. And in particular, Brazil, 1.4%. Middle East and North Africa, 2.7%. Sub-Sahara Africa, 3.4%. Russia, Central Asia, and Southeast Europe, 1.7%. So, what that really tells us is, despite the fact that, we may be slowing down to 2% GDP growth, among the world, it's still an incredibly strong number. And especially for a mature country. So strongest mature country, strong against the developing world. It just, the U.S. continues to be the engine of growth.
I agree. Growth is slower than what we've seen in the past. So it's not robust 3-4% growth. Expectation-wise, my expectation next year is 2.5%. Last quarter, what we were 1.9 was the last print for third quarter GDP. Fourth quarter, probably, the expectation is probably in that same range, 1.9 to 2.1. Overall, we'll probably end up the year at about 2.5. So not a horrible year, not a great year, just kind of a slowing economy, and we've talked about this before, that we're definitely in we've had a long expansion in front or leading up to this. How much room is there to go? There will be another recession at some point in time, but the reality is right now there's nothing pointing saying that, hey, we're going into an actual negative growth rate in the next 12, 18 months. Most strategists are starting to push the recession out even further, 21, 22, just because we're not seeing contraction, just slower growth. Cam mentioned earnings, growth estimates. Looking at estimates between 2019 and 2020, the expectations for 2020 are definitely better than this year. I think the consensus was that third quarter earnings were probably going to be, that was going to be the toughest quarter, and we're for the most part through earnings period, and it's really been the energy sector that has not been positive. The rest of most of other earnings, other industries and sectors have been positive earnings, so that's not quite as bad as expected. On the Fed front, obviously they've been reducing rates, not raising rates. I think that's a product of them just getting a little too aggressive with raising rates and stopping quantitative easing. Quantitative easing was something new. They didn't know what was going to happen when they started it, and to reverse it, what are the effects? Reversing that and raising rates was probably a bad idea. I think that's really what the Fed was trying to counteract. In the short term, I think between now and the end of the year, I don't think it's going to be too bad. I think we're going to see more advances in the market, and fourth quarter numbers are probably going to be as good as, if not better than third quarter numbers. So, in the short term, I don't see us falling in recession, and between now and the end of the year, or even early next year, that's for sure.
Well, and the biggest driver, obviously in the fourth quarter is going to be retail. Right. How's the holiday shopping season? How's the consumer doing? When those numbers come out in the beginning of the year, that'll really kind of hopefully point where the economy's headed.
I think, like you said, the consumer's strong. What we've seen the last couple of years going into Christmas is where they're spending money may be a little different. It seems like it's been a little bit of a surprise the last couple of years. We'll see if the trends that started 2-3 years ago continue, or if there's maybe a shift back to more traditional holiday type buying. That'll be something different, but the money's going to be spent. It's just a matter of where is really what it comes down to.
And if you've seen those prime trucks driving down the road, those prime vans.
All over the place, absolutely.
We can't, every day. There's a box from Amazon that shows up at our house. It's unbelievable what a juggernaut that company has become.
Let's talk about portfolios a little bit and the markets. I alluded to the markets a little bit. When we talk about the markets, October, our last call in October, things were getting a little dicey at the end of September. They were getting a little, things were a little rocky early October, and I think I expressed that, if it's going to be rocky, it's going to be early on in October. Once we got into earnings, I was hoping that things would improve through earnings. They actually did.
Yeah, show the direction.
Yeah, we finished the month close to all-time highs on October 31st. November 1st and November 4th provided all-time highs to both the S&P and the Dow. So the market's kind of broken through. And, from a S&P standpoint, we're always kind of pushing those highs that we had seen earlier in the year, never breaking through. We've kind of broke through them with a little bit of cushion, so that really looks good from a market standpoint, that we're able to push through those highs with a little bit of room. Talking about the Dow Jones year to date, and this is through October. This information is from Morningstar. The Dow through October was up 15.97%. So year to date, October itself, the Dow advanced 0.48%. So not 0.5%. One thing that's been weighing on the Dow has been Boeing stock. Obviously, they've had issues with the 737 MAX. That's put pressure on the stock. Year to date, though, Boeing is actually still positive, but it just hasn't gone anywhere. That's kind of held the Dow back. The S&P 500 through October was up 21.18%, and the month of October was actually 2.09, so a little bit over 2%. So the broader market, a little better action, and a good recovery month. And that all happened the last week and a half, 2 weeks of October. So we saw a big turnaround there. On the international front, Cameron was mentioning the international picture has not been strong, whether it's Asia, Europe. Definitely, they've been in a lot more of a slowdown than the U.S. has been. October is a little different month for them. For the EAFA, this number is actually through November 1st. That was up 17.53%. So about a 4% gain in October for the developed world. Emerging market world, once again through November 1st, up 8.64%. Same thing, emerging markets were up about 4% in October. So things were good in the U.S. Actually, the rest of the world, things, especially on the market standpoint, definitely improved. Some of it's probably a little bit more positive talk on the China trade issues. In talking to an emerging markets manager last month, what he's seeing is, he thinks, the downdraft international, they're somewhere at the bottom in the trough, and if anything, they may be starting to come out of it. So that adds a little different dynamic to forecast. I think the forecast Cam read, might be a little overly pessimistic, which has been really where all the analysts and strategists have been. They've been lowballing everything for the last couple of years. So there may be some more room for some upside surprises, at least in the short term. Typically, end of cycle, we're at a point where the market has performed well, but we still haven't seen a real exuberance in the market.
Right.
And
This market's not overbought.
No, it's not overbought. Valuations aren't crazy. What my mindset is, we get some good news. That's when we could start seeing the exuberance come in. So I think there's a decent amount of upside risk.
If we could get this trade issue, could the Dow go up 1,000 points easy and then be overbought? Absolutely.
Yeah,
I think that's the big issue. But right now, valuations are reasonable. It doesn't feel like the go of the late 90s or 2007, 2008. I mean, this really does feel today like a different market.
And that's my mindset. Until we see that strong push, I think where we're at equity allocation wise is good. Adding a little bit here and there, but really, as we always talk about, sticking with the quality side of it. We want to participate in this last push if it is the last push. If we just keep on grinding it out, this could go on for quite a while. It's just, if we get a big run, that's when I'm going to probably be inclined to
scale back a little bit, yeah.
Just because we've seen that movie before. Speaking of the portfolios, growth with income portfolio, this is based on sample clients where we have pure portfolios. Growth with income portfolio through October was up 13.56% for the year. October itself, 1.71%. Some big winners there. We saw a little bit of rotation back to tech. NVIDIA was up 15.48% for the month. Apple was up a little bit over 11%, 11.07%. Our two international funds that gives us emerging market exposure, the Murray, that was up 4.1%. And then our broad-based international fund was up 4.03%. So that definitely helped to the upside on growth with income. Detractors for the month, Nike took it on the chin a little bit, down about 4.65%. Year to date, we're up huge, but that was a little bit of a detractor. Exxon down 4.31%, and then Cisco down 3.13%. So two tech companies up big. Cisco pulled back a little bit. We don't have any issues with those, and that's just the normal ups and downs. In the price potential portfolio, through October, year to date, we were up 22.02%. So, good run so far in price potential. The reality, though, in October, the portfolio was actually down 0.58, so just a little less than 0.5%. Big gainers there. In price potential, we have Lithium Automotive, which is they basically used car dealerships in the Midwest. They were up 18.96%. I think 15 of it came in one day, about late in the month. Google up 3.37%. Google, we made good money in. Actually, we sold that yesterday just because of where the pricing is, and we're looking at some better opportunities. S&P Global up 5.31%. So besides lithium, not real big gainers. On the downside, Travelers hurt us. We actually sold out of Travelers a week ago or so, but when we did hold it, that brought us down gave up about 12%. Universal Health Services down 7.59%, and QSR, which is quick service restaurants, Burger King and so forth, they were down about 8%. It was interesting. McDonald's got beat up yesterday. QSR jumped about 5%. So things change quickly in that world. Dividend yield, our basically most conservative equity portfolio, up 19.78% year to date through October. For the month, up 0.5%. So kind of a mediocre gain there, but year to date being up almost 20%. We're pretty happy with that. Big gainers, Blackstone up 8.85%, Caterpillar up 9.96, Intel up 9.7, so some nice upside drivers there. Boeing in October was down 10.66%. As I said, we're actually hanging on to a gain there year to date.
Anytime your chairman's pulled in front of Congress, it's never a good sign.
You're going to get some negative market blowback.
Yeah.
McDonald's down 8.39, and then Kimberly-Clark down 6.46 for the month. We actually added to our Kimberly-Clark positions yesterday, so kind of taking advantage of some weakness there. In the small cap arena, our small cap fund year to date, 12.25%. October, tough month, down 1.08%. So small caps, they've been, they're a lot more volatile. They've struggled here and there. We did have some big winners. CBiz, a Cleveland company, actually up 16% for the month. Stockyards Bank up 10.76. Advanced Drainage Systems up 14.72. So some nice gainers for the month. On the detraction side, Etsy, which has been we've held that probably 12, 18 months now. I think we've more than doubled our money in there. We gave up about 21% in there last month. And then K-12, which is a education company, we lost about 25% in there. We were ahead of the game, but now we're a slight loss in K-12. So that's kind of the nature of the small caps, is up and down. Like I said, we're going to stick with our quality focus. I like the outlook. I think we're going to get some more gains into the end of the year. There's always going to be some volatility. Most of it, is going to be around, the big headlines. But in general, I think earnings will come in fairly solid.
Agreed.
And that's kind of where we're at. A couple things going on. Towards the end of the year, this month, I tend to look at a little bit of, tax loss harvesting, go through a lot of the non-taxable or the taxable accounts. If there's some opportunities to offset gains with some losses, I'll be looking at doing that a little bit this month. And then
required minimum distributions.
Yeah, everybody over age 70.5 or attains age 70.5 this month. We want to make sure you have your required minimum distributions out. A lot of people are already taking them throughout the year, but we'll button those up, so everything should be looking good by mid-December. And that's really where we're at.
Perfect. If you have any questions, as always, feel free to give Kelly or myself a call, any of your Ellsworth team members. And we'll talk to you again next month.
Thank you.